Have you ever seen the news and heard the stock market is soaring, but your own bank account feels, well, a little less than soaring? You hear about record highs and bull markets, but then you look around. You see friends struggling to pay rent. You see local businesses shutting down. It feels like two different worlds. And in many ways, it is. What if the stock market, this thing we are told, is the ultimate measure of our economic health, is not telling the whole story? What if it is more like a giant complicated game, a game with winners and losers, a game that has a huge impact on all of our lives, whether we play it or not? Today, we're going to pull back the curtain on the stock market. We will explore what it truly measures. We'll look at how it shapes our economy and our lives. And we'll ask the big question: is it a force for good, or does it create more problems than it solves? Stick around. The answer might surprise you. So let's start with the absolute basics. What even is a stock? Imagine your favorite pizza place. It's so good, it wants to expand, open new locations, and buy bigger ovens. But that takes a lot of money. More money than the owner has in the bank. So, the owner decides to sell little tiny pieces of the pizza business to the public. These little pieces are called stocks. When you buy a stock, you are not just buying a piece of paper. You are buying a small slice of that company. You become a part owner. If the pizza place does well and makes a lot of money, the value of your little slice, your stock, goes up. If it does poorly, your slice might shrink in value. Now, how does a company like our pizza place first sell these slices to everyone? That's where something called an initial public offering, or IPO, comes in. Think of it as the company's big debut party. It is the first time the company offers its stock for sale to the public. This is a huge step for a company. It's how they raise a lot of money to grow and expand. But it also means they now have to answer to all of their new part owners, the shareholders. This whole system of buying and selling these little slices of companies happens in a place called the stock market. But it's not a physical place anymore. It's a giant global network of computers where all this buying and selling happens in the blink of an eye. To understand the stock market of today, we need to take a trip back in time. Long before the internet and supercomputers, the stock market was a much more personal affair. It all started in New York City, way back in 1792. A group of 24 men, stockbrokers, gathered under a buttonwood tree on a street that would soon become world famous, Wall Street. They signed an agreement, the Buttonwood Agreement, to trade stocks among themselves and to charge a set commission. This was the birth of the New York Stock Exchange, the NYSE. For decades, it was a chaotic scene. Brokers would gather in coffee houses, shouting bids and offers. It was not until 1817 that they created a formal organization and rented a room at 40 Wall Street. The president would call out the name of each stock, and brokers would yell their trades from their assigned chairs. This is where the term seat on the exchange comes from. It was a real physical seat. The NYSE grew as America grew. Railroads, banks, and new industries all sold stock to raise money. By the end of the Civil War, hundreds of stocks were being traded. In 1867, the stock ticker was invented. It was a revolutionary device that transmitted stock prices across the country. For the first time, people outside of Wall Street could see what was happening in the market in near real time. The gap between Wall Street and Main Street began to shrink. Then, in 1971, a new kid showed up on the block, the NASDAQ. It was the world's first electronic stock market. There was no physical trading floor. All the trading was done through computers. This was a game changer. It made trading faster, cheaper, and more accessible. It became the home for a new generation of technology companies, like Microsoft and Apple. Today, the New York Stock Exchange and the NASDAQ are the two biggest stock exchanges in the world. They are the heart of the global financial system. But how do we make sense of all the chaos? All the buying and selling of thousands of different stocks? That's where stock market indexes come in. You have probably heard of them. The Dow Jones Industrial Average, the S&P 500. These are the numbers you see on the news every night. They are meant to be a simple snapshot of how the market is doing. The Dow Jones is one of the oldest and most famous indexes. It tracks the stock prices of 30 of the biggest and most important companies in the United States. Companies like Coca-Cola, McDonald's, and Johnson & Johnson. The idea is that if these big companies are doing well, the rest of the economy is probably doing well too. The S&P 500 is a much broader index. It tracks 500 of the largest companies in the US. Because it includes so many more companies, many people think the S&P 500 is a better reflection of the overall market and the economy. These indexes are incredibly important. They're used as a benchmark for everything. Investment funds, retirement plans, even the news media all use these indexes to measure performance. But here's the thing to remember. They are just a snapshot. They are not the whole picture. The Dow Jones and the S&P 500 only track the biggest of the big. They don't tell you what's happening with the millions of small businesses that are the backbone of our economy. And this brings us to a crucial point. The rise of the public corporation has changed everything. These are companies that are owned by thousands, even millions of shareholders. They are some of the most powerful entities on the planet. Their decisions affect all of us, from the jobs we have to the products we buy. So, who are the people playing this game? Who are the big winners? Well, you have the legends, the titans of the investing world. People like Warren Buffett. Buffett is famous for his value investing philosophy. He does not just buy stocks, he buys businesses. He looks for great companies that are selling for less than they are worth, and then he holds on to them for the long run. He is not interested in short-term gains. He is interested in the long-term success of the business. Buffett's approach has made him one of the richest people in the world, but it's a strategy that requires a lot of research, a lot of patience, and a lot of discipline. It's not for everyone. For most of us, the idea of picking individual stocks is daunting. That's where another revolutionary idea came in, the index fund. The credit for this goes to a man named John Bogle. Bogle was the founder of Vanguard. He had a simple but powerful idea. Instead of trying to beat the market, why not just own the market? An index fund is a type of mutual fund that holds all the stocks in a particular index, like the S&P 500. When you invest in an S&P 500 index fund, you are buying a tiny piece of all 500 of those companies. And because you are not paying a fund manager to pick stocks, the fees are incredibly low. This is called passive investing, and it has become hugely popular. It's a simple, effective way for ordinary people to invest in the stock market and build wealth over time. Warren Buffett himself has said that for most people, a low-cost S&P 500 index fund is the best investment they can make. But even with the rise of index funds, the stock market is not a level playing field. The richest 10% of Americans own almost 90% of all stocks. So when the market goes up, the rich get richer, much richer. And this brings us to the dark side of the stock market, the side that doesn't get talked about enough. For many public companies, the number one goal is to maximize shareholder value. That means doing whatever it takes to make the stock price go up. And this has led to a dangerous obsession with short-term profits. Instead of investing in research and development, or raising wages for their employees, or building new factories, many companies are focused on hitting their quarterly earnings targets. They will cut costs, lay off workers, and do whatever it takes to make the numbers look good for Wall Street. This short-term thinking can be incredibly damaging to the long-term health of the company and the economy. And then there's the issue of CEO pay. The pay of top executives has exploded in recent decades, and a huge part of that pay is tied to the company's stock price. CEOs are often given massive stock options, which become incredibly valuable if the stock price goes up. This creates a powerful incentive for CEOs to focus on short-term stock price gains, even if it means sacrificing the long-term health of the company. This brings us to one of the most controversial practices in the corporate world, stock buybacks. This is when a company uses its own cash to buy back its own shares from the open market. Why would they do this? Simple. It reduces the number of shares outstanding, which automatically boosts the earnings per share, and that in turn often leads to a higher stock price. In 2018 alone, companies in the S&P 500 spent a record $806 billion on stock buybacks. That's money that could have been used to invest in the business, raise wages, or lower prices for customers. Instead, it was used to artificially inflate the stock price and enrich executives and shareholders. This is not a victimless crime. When companies prioritize stock buybacks over investing in their workers and their communities, real people get hurt. We see it in stagnant wages, job insecurity, and a growing gap between the rich and everyone else. So, is the stock market a rigged game? In some ways, yes. It is a system that's tilted in favor of the wealthy and the powerful. It's a system that often prioritizes short-term profits over long-term prosperity. It's a system that can fuel inequality and instability. But it doesn't have to be this way. The stock market can also be a powerful force for good. It can channel money to innovative companies that are solving the world's biggest problems. It can help people build wealth and achieve financial security. It can be a driver of progress and prosperity. The key is to remember who is in charge. We, the shareholders, are the owners of these companies. We have the power to demand change. We can demand that companies focus on long-term value creation, not just short-term stock price gains. We can demand that companies treat their workers with dignity and respect. We can demand that companies act as responsible corporate citizens. This is where shareholder activism comes in. It is the idea that shareholders can use their power to influence corporate behavior. We can vote on shareholder proposals. We can engage with management. We can make our voices heard. There's a growing movement to shift from shareholder primacy, the idea that companies exist only to serve shareholders, to stakeholder capitalism. This is the idea that companies have a responsibility to all of their stakeholders, their employees, their customers, their suppliers, and the communities where they operate. This is not just a moral issue, it is an economic one. Companies that treat their stakeholders well are more likely to be successful in the long run. They are more likely to attract and retain talented employees. They're more likely to have loyal customers. They're more likely to be sustainable businesses. So, What can you do? Get educated. Learn about the companies you are invested in. Use your voice as a shareholder. Support companies that are doing the right thing. And demand a system that works for everyone, not just the few at the top. The stock market is a powerful tool. It can be used to build a better world, or it can be used to tear it down. The choice is ours. What do you think? Is the stock market a force for good or a source of our problems? Let us know in the comments below. And if you found this video helpful, be sure to like and subscribe for more content that helps you build financial clarity and freedom. Thanks for watching.